Okay, let's dive right into this milestone explainer. We've actually reached a pretty huge moment today. We are setting the stage for what I honestly like to call the highly refined, final form of moving average trading. This is the ultimate culmination of everything we've unpacked so far. We're taking the absolute best elements of trend following and completely stripping away the noise.
So you might be wondering, what exactly is the final form of moving average trading? I mean, if you've been following along with us, you know we started with the absolute basics, and we've slowly, methodically built up the complexity. But what if the ultimate answer isn't about slapping on more and more indicators? What if it's actually about finding the perfect mathematical balance that just out and out outperforms traditional moving averages? Well, that is exactly what we're looking at today. Here is our roadmap for today. First, the moving average finale. Second, the Goldilocks zone. Third, Triple EMA execution rules. Fourth, EMA separation ratios. And finally, Season 1 strategy rankings. All right, Part 1, the moving average finale. This marks our 10th strategy, elegantly closing the chapter on our moving average analysis. Think back to our journey for a second. We kick things off in week 1 with the Golden Cross, which is pretty much the simplest crossover possible. Then by week 3, we upgraded to the EMA ribbon, a 4-line system that gave us a great read on trend strength. But let's be real, it required a bit of subjective visual judgment. Fast forward to week 8, and we explored the MACD, a momentum oscillator measuring the gap between two averages. Now, the Triple EMA cross takes the clean 2-line simplicity of the Golden Cross, the rich multi-line context of the EMA ribbon, and the pure momentum confirmation of the MACD, and distills the whole shebang into one optimized system. Moving right along to Part 2, the Goldilocks zone. In technical analysis, finding an indicator that isn't too simple but isn't overly complex is basically the holy grail. If we contrast our previous approaches, something super interesting jumps out. When you use just 2 moving averages, like the Golden Cross, the signal is entirely binary. It's just way too slow, and it gives you literally zero information on trend strength between crossovers. But on the other end of the spectrum, using 4 EMAs, like the EMA ribbon, sure, it gives you incredibly rich data about how the lines fan out, but it's complex. Figuring out if a ribbon is fanning enough relies way too heavily on your own subjective visual judgment. So the crucial takeaway here is that 3 EMAs form the absolute perfect Goldilocks zone. It's just right. 3 lines create exactly 2 interactions, the fast line interacting with the medium line and the medium line interacting with the slow line. Their relative arrangement gives you 3 distinct, perfectly unambiguous market states. If all 3 are aligned, boom, you have a strong trend. If the fast line crosses the medium but the slow line isn't aligned yet, well, a trend is just developing. And if they're all tangled up like a messy knot, there is no trend. It gives you direction, strength, and exact timing, with absolutely zero guesswork. So let's meet the roster driving this system. First up, the EMA 5. This is your trigger line. On a 1-hour chart, it's covering just the last 5 hours. It is incredibly fast, and its one and only job is to tell you exactly when momentum has shifted in real time. Next, we have the EMA 13. Think of this as the confirmation line. It covers roughly 1 full trading session, and it's there to make sure the 5 EMA signal actually has genuine follow-through. And finally, the EMA 50. This is your trend filter. It's the macro gatekeeper. Honestly, it's popped up in half of the strategies we've covered because it's just universally reliable. It acts like a bouncer, simply asking, is the macro trend actually supporting this trade? Let's get into Part 3, Triple EMA execution rules. We're going to walk through the exact mechanical step-by-step for entering and exiting a trade. Okay, for a long entry, the mechanics are super strict, no exceptions. First, verify your macro alignment. If the EMA 13 isn't already above the 50, you just skip the trade entirely. Next, you wait for your trigger, the EMA 5 crossing above the 13. At the exact moment of that cross, you demand perfect visual stacking. The EMA 5 has to be above the 13, and the 13 has to be above the 50. Then run a volume check. We want to see the signal candle's volume sitting at least 1.5 times higher than the 20-period average. This confirms the institutional players are actually participating. Finally, you execute right at the open of the next candle. And this is absolutely crucial for survival. Place your stop loss exactly 1.5 times the average true range below your entry. It's a tight stop, I know, but it works brilliantly because the 1-hour time frame and those fast EMAs catch reversals incredibly early. Now, once you're in the trade, you have to follow strict exit rules. Your primary exit is triggered the very second the EMA 5 crosses back below the EMA 13. This is lightning fast. It protects your profits the instant short-term momentum shifts, even if the larger macro trend looks totally fine. You're also going to use strict profit targets, specifically a fixed 3-to-1 reward to risk ratio. Or, as an alternative, you can move your stop to break even once you're up 1.5 times your risk, and then use that EMA 13 as a dynamic trailing stop. In that case, you only exit when a candle closes completely below it. All right, part 4, EMA separation ratios. Let's slow down for a second and look under the hood at the hidden mathematical engine driving this entire system. You see, in quant trading and machine learning, you don't just sit around waiting to see if lines have crossed. You measure the actual mathematical distance between them. The EMA separation ratio is a continuous feature that measures the percentage distance between these moving averages relative to the asset's price. So instead of just waiting for a binary cross on your screen, this ratio mathematically predicts momentum acceleration and incoming crossovers before they even visually happen on the chart. In practice, this means we're tracking 3 specific ratios: the distance between the 5 and 13, the 13 and 50, and the 5 and 50. When all 3 are positive and increasing, it means the trend is rapidly accelerating. But pay close attention to the early warning note here. If ratio 1 starts decreasing, which means the fast EMA 5 is creeping closer to the EMA 13, while ratio 2 is still positive, it's basically shouting that short-term momentum is fading. It acts as an incredibly powerful leading indicator, flagging an impending exit signal long before the visual crossover actually fires. It's like having a crystal ball for momentum. Which brings us to Part 5, Season 1 Strategy Rankings. It's time to see exactly what a decade and a half of backtesting reveals. Out of 15 years of historical data across spot and perpetual markets, the Triple EMA cross boasts a massive 62% win rate. Honestly, that ties for the 4th highest win rate we have seen so far, and it pairs that amazing consistency with a highly respectable 1.05 Sharpe Ratio, completely clearing the benchmark for excellent risk-adjusted returns. Let's put that into perspective by comparing the whole moving average family tree. The Triple EMA lands right in the sweet spot between the EMA ribbon and the golden cross. It completely matches the ribbon's 62% win rate, but requires you to track one less line. But the most important comparison here, hands down, is with the MACD. The MACD uses a very similar fast and slow EMA concept, yet the Triple EMA outperforms the MACD on literally every single metric: a better win rate, a higher Sharpe ratio, and a lower max drawdown. Why? Because the Triple EMA's explicit rule, the one requiring all 3 lines to be perfectly stacked, is just a much stricter filter. The MACD can and will generate signals in ambiguous, choppy trends. The Triple EMA never does. Looking back across all 10 strategies we've explored, a massive overarching truth emerges from the data. The absolute best trend-following systems share 3 very distinct traits. First, they demand multiple confirmations, not just a single lazy crossover. Second, they have a built-in don't trade state that keeps your capital safe during ranging, sideways markets. And third, they adapt to market volatility rather than relying on fixed, arbitrary distances. As you can probably tell by now, the Triple EMA cross embodies every single one of those principles perfectly. So that brings us to the end of our first major chapter. We've mastered moving averages, taking it all the way from the basic golden cross up to this optimized 3-line system. But the markets are vast, and there are tools out there that don't rely on smoothed price averages at all. We're talking channels, volume-weighted methods, nonlinear tools, and that is exactly where we're heading next. So the question is, with the moving average loop officially closed, are you ready to leave them behind and master what comes next? I'll see you in the next explainer.